Welcome back to another episode of MBAs Teach Econ. In this lesson, we're going to discuss the foreign exchange market. We'll put our Y and our X here. Before we discuss the foreign exchange market, we need to discuss what a nominal exchange rate is, or E, which is units of foreign currency over 1 unit of domestic. So we might say the nominal exchange rate for won to US dollars, maybe it is 10 won for 1 US dollar, or 10 to 1. In the foreign exchange market, the nominal exchange rate is on the y-axis. On the x-axis, we have quantity of domestic, and I'm just going to leave domestic here, domestic currency transacted. Now, as we move up the y-axis, our domestic currency appreciates. As we move down the y-axis, our domestic currency depreciates. So we might have 10 to 1 won to US dollars at the top, and maybe 2 to 1 here at the bottom. The demand curve in the foreign exchange market represents the level of demand for domestic currency at each given exchange rate. It is downward sloping because holders of foreign currency demand more domestic when the exchange rate is in their favor, i.e. 2 to 1. The supply curve represents the level of supply of domestic currency at a given exchange rate. The supply curve is upward sloping because holders of domestic currency are more willing to supply when the exchange rate is in their favor or when domestic currency appreciates. For example, at 10 to 1, you're willing to supply more up here than down here at 2 to 1. These quantities trace down here to the x-axis, and you can see Q2 is higher than Q1, just like holders of foreign currency would prefer Q2 over Q1. Now, this foreign exchange market can have a real impact on trading partners, and we'll explore that using China and the US. And we're going to use the real exchange rate here, capital E, which is just the nominal exchange rate converted to incorporate the price level in each country. We're also going to incorporate our equation for net exports. So net exports are equal to exports minus imports, or X minus M. And on the left side here, net exports are going to be less than 0. And on the right side, net exports are going to be greater than 0. We're going to use differing exchange rates along this slanted line. So this one here could be 10 to 1. And over here would be our 2 to 1. Now we're going to see how a change in the real exchange rate can have a meaningful impact on the U.S. labor market. So the U.S. labor market is up here. On our y-axis we have wage, and on our x-axis we have quantity of workers. Now let's explore in a situation where we move from a 2 to 1 relationship to a 10 to 1 relationship. So from the right side to the left side. So we know that if we move from 2 to 1 to 10 to 1, that U.S. goods and services are becoming relatively less attractive, and that imports are becoming more attractive because we can buy, in this case, 5 times as much, which increases Chinese imports into the U.S. and also decreases the relative attractiveness of U.S. exports to China, therefore leading to a net exports of less than 0, or a higher M than X. Now, what effect does this have on our labor market? Well, if we have a demand for labor, we'll call that D1, prior to this change, and we have an overall supply, and this supply of labor is not going to change at all. But when the foreign exchange rate goes against us, or we can buy more Chinese yuan for that dollar, the demand for goods and services falls, and in turn, the demand for U.S. workers falls as well. And so the overall quantity of workers would fall from here, Q1, down to here, Q2, resulting in less employment, less consumption, etc. So this level of exchange rate has a meaningful impact on the U.S. economy and especially on our labor market. Now, this has been a brief overview of how a foreign exchange market works and a specific application of a real exchange rate change between China and the U.S. Thanks for listening, and see you again soon.